So I am a person who is an economist. This talk will probably be a little academic compared to what some of you are used to. But I hope that this helps us think a little bit about the Indian banking crisis 2018. The earlier periods when we had the banking sector undergo a crisis, there were several other instruments that the policymaker, the government could have brought into play and did bring into play in order to solve it. Okay, but it was just solving the crisis. It was not solving the reasons behind the crisis. So here, there has been a ton of papers, articles that people have been writing about this crisis. I'm sure that you've read all of it. It's becoming particularly exciting now because earlier the only thing that we used to talk about was an NPA crisis. It was a credit crisis, right? That banks had made loans and these loans had failed in a big way. Today we are seeing a different facet of the crisis, which is illuminating or illustrating a different kind of risk that people were very comfortable not thinking about in the banking sector. I'm sure that all of you have started worrying about these kinds of risks about 10, 15 years ago. Banks are also thinking about it, the banking regulator was thinking about it, and I think it's interesting how, if I asked any of you how you were dealing with these risks and how the banks have dealt with these risks, it has actually emerged in a very different way. Okay, so I'm hoping to give you a bit of a 30,000-foot view, and it will require you to think a little bit about something that perhaps you may not spend too much time thinking about. So what's the structure of this talk? I'd like to talk about a general proposition that what does it mean to have crisis risk management in the financial system, and where do regulations play a role? I promised, right, this is going to be stuff that you probably don't think about usually. Then we go into the crisis at Indian banks, and note, here I talk about it in the plural, and then how can you all, and this is not just about Indian firms responding, right, it's about how all of us can respond. And as a country, I think we need to stand up and take a stand. Okay, so where does regulation play a role in crisis management? Okay, and I'd like to just step back and say, unless all of you are very comfortable with it, and you can put up your hand and say, this is boring stuff, please skip the slide quickly. I'd just like to say, what is regulation all about, right? Regulation is actually about setting down a bunch of rules and paths through which we ensure good behavior, right? So you are all regulated entities. By the way, how many of you are listed companies? Cool, not all of you are listed companies, but both for unlisted firms as well as listed firms, you have regulations, some rules that you have to follow. And so this is the norm in today's world, that when you have to talk to people outside, you have to say that I'm a good person or a bad person. And what regulation does is lay out what the definition of that is. Now, all across the world, and this is something that has evolved from, say, before the 2008 credit crisis, which was a big financial sector crisis globally, to today. Today, we say that if you look up at what should be your expectation from a financial sector regulator, right? These are the functions that we expect them to do. Number one, we expect them to look after our interests, right? So consumer protection is one role of good regulation. Number two, and this is the old-fashioned way of thinking about it, that a regulator monitors a regulated entity's health. Right? They are making sure that, number one, they understand what the health of the regulated entity is measured as. They are monitoring it. And if there is a problem, then the third part comes in, that if you find that a firm is unhealthy, how do you resolve it? How do you solve the problem? Either we help the unhealthy company become healthy, or we say the unhealthy company has to shut down. And there's a standard procedure through which this is to be done. And last, it is about systemic risk regulation. This is what has come up after the 2008 credit crisis, because there all financial firms appear to get influenced. So these are the four things that a financial sector regulator is expected to be in charge of. And the question is, what does this have to do with crisis? Okay. I'm going to focus a lot in the talk about microprudential regulation, because here is where I say it's defining and monitoring the health of a single firm. Okay, so let me just think about it or explain this microprudential function for the financial sector specifically, not for a generic firm. So under microprudential functions, the regulator has the ability and the power. Note, this is the power to do these things. They can make rules of how financial leverage and risk is to be measured and managed. They can monitor the behavior of the regulated entity, so I can watch how the regulated firms are behaving. And if I find that there is, as a regulator, if the regulator finds that there is anyone who's deviating from the rules, they can award punishment. All of you are regulated entities. You see this, you know this. This is the life that you're used to leading, especially those firms that are probably listed firms, who have a greater set of rules and regulations. Now, why is all of this done? Presumably, the assessment is that all of us, if we behave by well-established rules, and these rules are very transparent, number one, we know what it takes to be a good person, right? Then if we are behaving by the rules, we expect that everybody will look at us and say, okay, you're a good person, and therefore I have more faith in you. It gives some sense of transparency and expectation and certainty to people who are in the system being regulated. It is also giving that level of comfort to people who want to interface with you and interact with you. So good regulation, clear regulations are a good thing to have because it imposes some standards of expectations of good behavior. And then, of course, it also tells us when you deviate, what's going to happen to you. So certainty of all of these rules is critical if we need to be comfortable saying that this is a good regulatory system. So when I say that this is the regulatory framework, these are the functions, what does it mean to say that I have a good regulatory system? When I have regulation that is done well, please don't fool yourself into thinking that everybody in the ecosystem will be a good person, right? I am defining who's a good person by setting out good regulations. There will always be some people who are bad people, right? We know this even in our industries, that most of us are doing a good job, most of us want to do good things. There will always be one or two bad eggs, and these are the people who will fail to adhere to good the good rules or the rules about good behavior. So even in the financial sector, even if you have an excellent regulator, there will be some financial firms who will inevitably fail. Right? So failure is part of business, and when regulation is done well, there will be some failures. But what a good regulator actually does is say that there is an expected failure rate. So suppose I'm a regulator, I'm sitting in a financial system, I say that even within my rules, if everyone behaves, there is going to be some business failure, and say 4 in 1,000 banks, I'm the regulator of the banks, is expected to fail in a year. Why is this an interesting number? Because this becomes a standard of regulatory competence. Number one, I expect that not more than 4 out of 1,000 banks will fail in a year. If there's something more that is consistently happening, I tend to worry. If there's something less, I wonder, am I being too strict, right? Is the business actually going on as it should be? So these are all benchmarks, and all I wanted to say in this slide is good regulation doesn't mean that a business will not fail, or that a bad penny will come up and some malfeasance will happen. But it is a limited amount, right? It's not going to be extreme. Let's look at the Indian banking crisis within the context of what I just talked about in terms of a well-regulated framework. We have banking crises repeatedly, and there is a mismatch between the two. How can we have healthy firms, which is a bank which has no problems internally, and yet we are faced with these banking crises repeatedly? So here's a story that I can infer. Number one, there is actually systematic failure across the individual banks. And this is because, as I said, microprudential regulations is supposed to monitor and manage the health of individual firms. There is actually systematic failure across individual banks, which is a failure of microprudential regulations. There has been no large-scale resolution. So there's no effort that we see in going out and saying there's an identified bad, unhealthy bank and we have to resolve it, either as winding up, takeovers, or mergers. When you have systematic failure, they have summed up to a crisis, and then taxpayer funds get moved from building roads and sewage systems into rescuing banks. Because please remember that every time we go out to resolve a crisis, there is a cost. There's an opportunity cost of having worse roads or no roads and really bad garbage collection in the country. So the two statements appear to be contradictory to each other, but actually it can be consistent. What I need to do to have these to be consistent is there is actual systematic failure, but it's hidden from the public. So we never get to see it, and a crisis is the first time that we understand that there's actually unhealthy banks in the system. So India apparently needs to solve two things. Number one, it probably needs to solve microprudential regulation, because we cannot have a crisis without unhealthy banks. So we have unhealthy banks, which means that individually each bank has to become stronger. But for that to happen, there are many ways to solve it, but we do need to have good microprudential regulations. That means we need to have a transparent framework saying this is a healthy bank, this is an unhealthy bank, and if that is missing, we will have a situation where we don't understand that an individual bank is unhealthy, and yet we end up with a crisis. Second thing that we need to understand is that when we find these unhealthy banks, how do we resolve the problem? So here is where we think that the evidence of crisis is actually failure of microprudential regulation in India. Microprudential regulations, as I said, focus on ensuring good health of the regulated entity. In this case, it's a bank. Health is availability of capital to cover known risk. So there are two elements to it. One is the capital requirement, but the second part is where is the risk coming from? Where is the risk in banks coming from? There are typically three sources, right? Number one, their core business, which is making loans. You make bad credit decisions, you will end up with a bad NPA situation, and that's a risk that you have to face. It's not something that you deliberately set up to do. Sometimes it's out of your hands. But if it's this endemic and this systematic, then it's most likely the case that we have a problem with banks that don't know how to do credit risk management too well. Second is operational risk, which is what we are seeing today, that there is the way that a bank is supposed to operate, there are gaps in that operation, and that has led to problems. And the last is liquidity risk. Now, if you think about who's the microprudential regulator for banks in India, of course, it's the Reserve Bank of India. And you may say, actually, perhaps this is a powerless regulator. It is not able to do anything by way of ensuring microprudential regulation. But for all people who are in India, who look at the Reserve Bank and its behavior with banks, we know for fact that RBI is not an arm's length regulator. How do I say this? That the number of, if any of you have been curious enough to go to the RBI website and see the number of instructions that it delivers by way of legal instruments. Okay, we are used to thinking about regulations. RBI has multiple ways in which it sets regulations. Remember, regulation is defining the framework of what is good behavior and what is not acceptable behavior. So they have numerous regulatory instruments. They can issue regulations. They issue circulars, master circulars, directions, notifications. Today, over the last 2 or 3 years, they are issuing regulations, i.e. what is permitted behavior, what is good behavior, bad behavior, in the form of press releases, policy announcements. Today, even a deputy governor or governor's speech is able to set the behavioral definition. Now, this becomes very difficult to monitor because there are so many ways in which the definition is setting out that if a random person is picked up and said, what is a good behavior or good health for a bank, they'd have to scan all of these instruments to figure out what it is. So it is a problem, but that's what it does. The other part of it is the frequency with which these regulations are changed. Okay, if you go to the website, so I'm an academic, I do this for fun, but if you pick up a year and you say how many of these instruments are issued, okay, you will see that just circulars alone, which is one out of the multiple things that RBI issues to the public, just circulars alone was about 629 circulars in 2012 and 622 circulars in 2013. You know, this is the number is more than one. That's 1.7 circulars per day in the year. Okay, of course, I divided by 365, and I don't think the RBI chaps work on Saturday and Sunday. So I should have divided it by 250. That would have been more than 2.5 circulars per day. That means the rules by which ill health or good behavior of a of a bank or one of the regulated entities of RBI is supposed to be governed by changes or gets modified two times a year, a day in a year. Okay, so that's quite frequent. Even despite all of this, we are running into crisis. So what's going wrong here? There is a standard problem. We've talked about, we sort of acknowledge it in India and absorb it into our DNA, that there is a difference between proposal, that is the issuance of a regulation, and implementation of a regulation. So issuing instructions or regulations does not automatically mean that they are implemented. Okay? And implementation requires monitoring, at the very least. Okay? And I'm sure all of you are reading about how the gaps in the monitoring has been the bigger problem in the case of the latest reconciliation of two records of a transaction that has happened between the bank and an issuing and the foreign bank. Now, if it is a case that you have good monitoring systems, Monitoring can find a gap between the regulated behavior, that is what is good behavior, versus the actual behavior. Then regulators in India, financial sector regulators, have tremendous powers to, number one, penalize the entity that has deviated. The magnitude and the frequency of the penalty. So if the regulated entity chooses to ignore the regulator's penalty, then the magnitude and the frequency can go up. And at the end, there can be a ban and forced closure of the entity. Okay, so this is like an escalation. And I don't have to tell any of you, because as regulated entities, this is the kind of pattern that we will see in all systems, right? RBI has got special powers because they have the perfect right to go out and issue a closure of an entity with very short notice, and the entity that has been shut down has no ability, no court that it can go and appeal to other than the Government of India. So usually regulators, like for instance, if you're a regulated entity under SEBI and you have an order passed for penalties or for closure of business or a ban of your business, you can go and appeal to the Securities Appellate Tribunal. In the case of RBI, there is no such. The place that you have to go to is the Government of India. Okay, so good regulators, good regulatory behavior is done not just by issuing regulations that need to be thought out, but it has to be enforced, and the enforcement is typically forced, especially if you're a regulator of a very large number of entities. You can't possibly go and monitor everybody every day, but what you can do is to say, please disclose what I'm asking for, because I'll use the disclosures to see whether you're complying or not. Of course, the regulator does not have the ability to possibly go through all the disclosure, so then they fall back on audit. Right? So you ask the auditor, you have an internal auditor that's supposed to set for processes, you have a statutory auditor. In RBI's case, they also have a supervisory auditor, so there are multiple levels of audit that's supposed to sit down and ask whether banks are complying with what has been regulated. RBI has got all these powers to audit, find disclosure, find misbehavior, and penalize misbehavior under the Banking Regulation Act. And yet, if you actually look through the records, there has never been a point at which any bank has been penalized. Okay? So for example, ICAI has detailed guidelines on audit practice standards for banks. Okay, these have gone through many changes, especially after 2008, 2009. In 2017 is the latest guideline, and if you go through it, you will see that there is an entire section on swift record reconciliation, and it's quite detailed. RBI adds on to these, and the question is, what penalties did RBI impose after having found that there were gaps between the two records, and these were found in 2015, 2016? Was even 1 rupee of a penalty imposed on any bank that was found in 2016, 2017, or 2015, 2016 to have violated this disclosure? Okay, as far as we understand, none. We cannot find any record of penalties on banks. Number 2, on the NPA problem, if anyone looks at the CDR, that's the corporate debt restructuring process, which has been in place since 2003 onwards. If you look at who are the people who get these, the benefit of the CDR, you'll find typically it's the worst performing firms or the worst performing loans. Even after having been given a restructuring plan that is supposed to take 5, 10 years to bring the firm to revival, the firms have not revived. When RBI looks at these cases, do they increase the provisioning norm? So 10 years the firm has been given to become healthy. They have not. Does RBI increase the penalty or impose provisioning norms that are higher? Not at all. So to a certain extent, RBI has never taken action against the banks who have been found to be misbehaving against their own directions and their own circulars and their own regulations. But the fact of the matter is that not a single penalty has been ever issued. There might be conversations where banks have been slapped on the wrist, but if you as a public citizen who's been asked to put up funds to bail these banks out, ask, what penalty action have you taken? You have all of these powers under BRA. Where is the action that you've taken to penalize the misbehaving banks? Okay, we cannot find any evidence. We'd be very happy to, if you could help us understand some of this stuff, because you probably have better relationships with banks than we do. So what is to be done? Crisis resolution part 1. Today, apparently the taxpayer payout promise is about, I think, 2,000 lakh crores, or is it 2 lakh crores? I forget, but it's 2 trillion rupees of money. Okay. That's a heck of a lot of money. You can build quite a few large number of highways using this money, right? But we are going to be putting it into the banking sector, which has had this crisis at least twice in the last 2 decades, and they have not improved themselves. And if you look at the actual numbers, especially now that the operational risk problem is coming up, the requirement appears to be much more than the stated amount. The other larger problem that we need to worry about is that if it was a regulator who had oversight on a crisis, and you were in charge of these banks and they came up to you with a crisis of this nature, are you allowed to completely continue with as yourself? This is like saying that you're a firm, you're a management that saw the firm undergo a crisis. The shareholder might come and bail you out in the sense they can give you fresh capital, but are they going to say, please continue with your processes as is? Not going to happen. So one of the things that we need to seriously think about is how do we reform the regulatory agency or the RBI? So way forward some suggestions. All of us should stand up and say, let's please limit the public money going to banks, right? It's been too frequent, too fast. Okay, you said 2 trillion, but please this far and no further. So obviously if the banks cannot be bailed out, we are going to be in a credit crisis. Are we not in a credit crisis today? In my understanding, the kind of monies that is going out to investments in the public, into enterprise is actually gone down sharply, and it's already a credit crisis. So we do need to find new mechanisms of getting financing, and these have emerged, some of them, and they will continue to emerge because that's what's happening all across the world. The world has seen a credit crisis over the last 10 years, and they have not stopped and said, let's solve banks. They have said, let's look at other sources. So public markets is one. Lower capital controls is something that we should now seriously consider, because I think for a lot of us, we're used to doing capital account transactions, but it's being limited. We have better risk management tools today in our hands, like derivatives markets on public exchanges, and they help us manage the risk. So why not do this more? Number 2, we must reform the regulatory process. We can't let the regulators go scot-free because they are the ones who were in charge when this mess happened. Okay, and now if you all have had a chance to look at this proposal of the Financial Sector Legislative Reforms Commission, they have proposed a new law for the financial system, which actually creates a completely different architecture and imposes more accountability on the regulators. Okay, so there's a clean and transparent way in which you say, this is how you will ask for behavior, but when you ask for behavior, this is how you should be accountable. And that's called the Indian Financial Code. Once we have started on this, we can start the privatization of banks. Because if we do the privatization of banks right now, it's being done at the worst possible place. Thank you.